Hey everyone, welcome to This Explainer. Today, we're tracking a fascinating and honestly kind of hidden chain of global events. We're going to see how a bold, unprecedented legal move happening halfway across the world in Beijing could literally dictate what you pay at your local gas pump. It's a massive web of international trade, geopolitics, and economics, but we're going to break it down and see exactly how it all connects. So, how exactly does a Chinese legal statute affect the price of your gas? Well, to figure this out, we're leaning on a really interesting economic analysis by Professor Richard Wolff. He connects these high-level international trade disputes right back to our everyday domestic expenses. It's a brilliant look at cause and effect on a totally global scale. Here is our roadmap for This Explainer. First, we'll look at China's historic blocking rule. Then, the end of tiptoeing, the threat to the dollar, the petrodollar and oil, the fossil fuel trap, and finally, a changing global reality. All right, part 1. China's historic blocking rule. You see, the catalyst for this whole global shift wasn't a military action or a new tariff. It actually started with a highly specific and frankly unprecedented legal maneuver by China's Ministry of Commerce. According to our source, Beijing recently invoked its 2021 blocking rules for the very first time. They basically ordered Chinese firms not to comply with U.S. sanctions. Specifically, this was triggered to protect independent Chinese oil refineries that were accused of buying Iranian crude oil. Beijing actually called the U.S. measure an unjustified and improper use of extraterritorial law. And you can imagine the immediate chaos this causes for global business. It creates a massive, almost impossible trap for multinational companies. Think about it. If a global bank complies with U.S. sanctions, they are now directly breaking Chinese law. But if they follow Chinese law and keep dealing with these refineries, they face the massive risk of secondary sanctions from the U.S. They are caught perfectly in the middle.
Moving on to part 2, the end of tiptoeing.
Professor Wolff argues this is way more than just a minor legal spat. It marks a fundamental departure from China's old geopolitical strategy, which usually involved quietly dodging American foreign policy. Wolff explains that, for years, countries facing U.S. sanctions would just kind of find evasive ways around them, right? They'd pretend they didn't notice, rather than confronting the U.S. directly. But with this blocking rule, China is essentially saying, no more Mr. Nice Guy. They aren't tiptoeing around anymore. They're throwing down the gauntlet and serving notice to the world that they won't let their banks be inconvenienced by U.S. sanctions.
Which brings us to part 3, threat to the dollar.
So let's look at how this localized defiance ripples out to a much bigger macroeconomic issue. What starts as a dispute over oil refineries quickly exposes a growing vulnerability for U.S. dollar hegemony. I mean, the dollar is still the most important global currency, but it is losing its grip. Historically, the U.S. dollar held a massive 80% share of global central bank reserves. Today, that number has dropped down to roughly 50%. Wolff describes this rapid decline as a complete sea change in what the world counts as secure. Now, combine that declining dominance with another major milestone. The U.S. national debt now officially exceeds its gross domestic product. Wolff points out that because of this, global lenders, whether they're foreign countries, companies, or banks, really have to weigh the rising risks of holding American debt. Will they stop lending entirely? Or maybe more likely, will they demand much higher interest payments to compensate for the risk of lending to the #1 debtor country in the world?
Part 4, the petrodollar and oil.
To really grasp the stakes here, we have to look at the petrodollar system. Wolff notes the system is taking a heavy hit, especially with conflicts in the Middle East, where nations like Iran have successfully damaged gas and oil facilities. He describes what he calls a crazy global loop. It goes like this. The U.S. buys goods from China, so China acquires U.S. dollars. Since oil is priced in dollars, everyone wants to hold them, and the best way to do that is by buying U.S. Treasury securities to earn interest. So China lends that money back to the U.S. And here's the real kicker. The U.S. then effectively uses that borrowed money to fund foreign conflicts, bypassing the need to heavily tax its own citizens to pay for those wars. In some cases, China is effectively helping to finance conflicts they politically oppose. But as the petrodollar weakens, this whole bizarre system is threatened.
Next up, part 5, the fossil fuel trap.
All right, as promised, let's bring this boomerang right back to the U.S. domestic economy. Wolff identifies a severe catch-22 tied directly to energy policy, and this impacts you directly. On one side of this trap, U.S. consumers are taking a massive hit. At the time of this analysis, the national average gas price was hitting $4.44 a gallon, and it was soaring over $6 in states like California. High oil prices are an absolute punishment to the American consumer, who's just trying to commute, run a business, or literally just live their daily life. But wait, because it definitely gets more complicated. Wolff points out that a huge glut of oil could be on the horizon. Countries like the United Arab Emirates are actually withdrawing from OPEC's traditional quota systems. They have millions of oil. We're talking 1.5 to 2 million more barrels a day that they actively want to pump. They simply refuse to hold back their supply just to artificially drive up prices for the cartel anymore. So here's the impossible contrast. High prices hurt American drivers terribly, for sure. But what if the UAE floods the market and prices crash down to, say, $25 a barrel? Well, according to Wolff, that scenario bankrupts the U.S. Midwest fracking industry. And since that entire industry runs on heavy bank loans, their collapse would directly slam the American banking sector. It's this precarious balancing act where neither extreme offers a safe landing. Finally, Part 6, a changing global reality. Ultimately, as we pull all these threads together, Professor Wolff suggests that these intense economic pressures, from the gas pump all the way up to international law, are symptoms of a profound shift in global power dynamics. Neutrally speaking, from an economic standpoint, the era of uncontested U.S. economic dominance is ending. The U.S. just doesn't dictate the world economy alone like it did in the late 20th century. We are rapidly moving toward a multipolar reality, and it's something the nation simply has to adapt to.
To really illustrate this, Wolff makes a stark comparison to the British Empire. He notes that the British generally acknowledge their era of empire is over, even if they keep the pageantry, but he suggests the U.S. is operating in a state of denial, making critical policy decisions based on this outdated assumption of total global control. And when you make policies based on a reality that doesn't exist anymore, well, it eventually waxes us right in the wallet with unexpected consequences, like uncontrollable inflation.
Which leaves us with a pretty vital question to ponder. As the global economic chessboard completely reorganizes itself, as nations refuse to tiptoe, as the dollar's dominance shifts, and as energy markets face impossible traps, what will this new multipolar reality ultimately cost you, the everyday consumer? How are we all going to adapt to the new price tags of international trade? Thanks for hanging out with me for this explainer. Keep your eyes on the data, and always keep asking the big questions.